Hello and welcome to Deal Flow, the show that taps into the world of investment banking, corporate takeovers and private equity deals, all on your screen. I'm Erica van der Merwe. Despite the tentative pickup in global economic activity, uncertainty and caution remain pervasive themes. The same applies in the deal-making world, and that includes the mining sector. Recent research from PwC finds that the number of deals across the mining sector globally fell by 31% in the first half of this year. That's compared with the same time last year, which already was considered a slow time for deal activity. Coming up on this show, we are discussing the outlook for mining, merger and acquisition activity. But first, we look at our deals of the week. South African lender Standard Bank confirmed last week that they are in talks to sell a controlling stake in its London-based global markets business, a deal that could be worth over $500 million. The top shareholder in South African drug maker Adcock Ingram has put the brakes on a $1.3 billion takeover offer from Chile's CFR Pharmaceuticals, saying the deal was not in its best interests. South Africa's third largest insurance company, MMI, said it had bought Guard Risk for 1.6 billion rand from Alexander Forbes, a move that could help bolster MMI's short-term insurance exposure. Europe's largest retailer, Carrefour, is in advanced talks to buy more than 100 shopping malls in France, Spain and Italy, owned by real estate group Klépierre for €1.7 billion. Volatility and uncertainty in the mining sector have had a noticeable impact on merger and acquisition activity in the industry in the first half of 2013. Analysts believe M&A activity in the mining sector is likely to remain lethargic for the remainder of this year and into 2014. Now in studio with me to discuss this further, Stephan Le Roux, Senior Dealmaker at Bravura, and Nick Norman-Smith, Chief Investment Officer of Lentus Asset Management. Welcome, really good to have you here. Stephan, let me start with you. So just in reference to the PwC report, and there have been others, EY have given us a similar message. So deal making, volume, value, however you measure it, is down. So we know the sector, the mining sector, commodity prices, is under pressure. From your experience though, what's your gut feel explanation for what we're seeing?
I think that in the junior mining space, for example, I think a lot of the investors in that market has actually pulled back. They want to see real value. They're not sure where to put their money, and I think that they a little bit sick and tired of this value uplift curve, where you drill a couple of holes and you get a resource statement. They're now looking at saying, well, we need some infrastructure around these assets. How much is the infrastructure going to cost? How far is this asset from port? So those questions aren't being asked, and the guys are saying we've got to focus where the money's going to come from first.
So Nick, is this typical? In the tough times, investors become a bit more discerning and more challenging, wanting more value for their money?
Yeah, this is classic resource cycle. You see it every time. So back, resource CEOs, for example, in the listed businesses are notoriously bad at capital allocation. So what happens is, just when they should be pulling back, they're investing, and that causes a natural oversupply. So if we look back at the big listed, the big majors, between 2000 and 2005, less money was spent than in 2012 in capex. So clearly, just when they should have been investing in the early 2000s, no one was. Hence the money that was made. So it's classic supply and demand. And look, I'm probably not going to get too many Christmas cards from the resource CEOs, but in their defense, there's a lot of pressure from the market. And what also happens is they're earning so much money at the top of the cycle, the money starts burning a hole in their pocket. And rather than actually turning it down, paying out dividends, they start buying back shares, and et cetera, et cetera. Now we've got to the point where now everyone's suddenly, let's hold things back, let's be careful, let's be defensive. So everything that Stephan was mentioning, surely that's logical stuff that you should be looking at any stage, but it's not. When things are going great, people just start digging holes, and the margins look so good. The iron ore a few years ago was trading at nearly $200. It's now at just over 100. So you can imagine what your capital project forecasts and your profitability, what that does to your model when you plug in 200 versus 100, and hence everyone's starting to pull back just at a time where you should probably start started looking at actually buying assets.
So Stephan, on this point that Nick makes on the capital allocation behaviour by the big players, this is touted as a further reason why we're seeing such weakness in the capex spending, in the M&A activity amongst the miners, is because of those very poor recent decisions that many have made in some of the acquisitions they've made, in some of the expansions they've done. And so many of them have been replaced by new CEOs, so perhaps they're also still finding their feet.
Yeah, I think you have to be careful. I mean, you want to find your feet, you want to do your restructuring, you want to make sure that your money's going the right way and the right place, and that the financial models have been run properly and checked and double-checked. So certainly, yeah, it's cautious times.
And staying with that point to a certain extent, so the data suggests then that the deals that we are seeing, they're in the mid-tier space. So these big players are the ones that we've spoken about. They're sitting back, finding their feet, talking to shareholders. There's some sort of restructuring at the board level. But it's the mid-tier companies who possibly are in a healthier condition and doing the acquisitions. Stephan?
Yeah, I think everybody's sitting back. I think that the majors have pulled back, so obviously, with them pulling back, everybody's that's going in, talking about the junior space, that goes into places like Mozambique, are saying, well, if the majors are pulling out, why are they pulling out? Where are they going to consolidate? So I think that's the phase that we're in.
There's a great quote from Ivan Glasenberg, one of the dons of the resource industry, and he said at a recent presentation, the industry needs to learn about supply and demand. Why really? The smartest guy in this come from him, and it's so true. But surely that's always been the case. And it's interesting if you want to go and do an exercise and look back at the commentary out of these companies just 2 years ago. Words like growth, expansion, all of this was coming out. Now suddenly it's
great
all
confidence.
Yeah, great confidence. Now it's all pulling back. Operational strength, efficiencies, so yeah, it's a relatively short time period. But I think possibly some of the smaller deals are probably being done by maybe some of the smaller money. There's nothing better than buying an unwanted asset from a listed business because they just want to get it out. And there's been a lot of money made from people who've done that in the past.
And Stephan, if we look at the nature of some of these deals, from what I understand is whatever deals that we are seeing, aside from the fact that their ticket size is much smaller, they tend to be of a defensive nature, as Nick says. So people getting rid of non-performing assets or that might not be part of the core business. So it's quite defensive behavior, cost-cutting, and there's a lot of element of delay as well.
Yeah, if you take the platinum industry, for example, you'll find that many guys, investors have taken the asset up to a certain point and thought, okay, now the big money is going to come in. And now they're saying, hang on a second, maybe we should consolidate. Maybe we should use the neighbor's shaft. Maybe we should not go down to the deepest level and just mine sort of the first level first. So it's those sort of discussions. And most of those opportunities need a big daddy. It needs a sort of a Russian investor, or it needs somebody that's really going to take charge of this thing and not just, you don't want to get stuck halfway. You've just listed, you've done your drilling, you've done your bankable feasibility study. But now is the time to find the investor that backs you, that take you all the way. I'm sort of talking a lot around the junior mining space, but obviously the majors, it's every place different. Yeah.
So talking about needing a big daddy in the Russians, and Nick, this very report of PwC that I referenced, look at deal value by region, whereas in the past you had Canada and Australia featuring rather high up on that list. It's shifted around. You've got Russia and Kazakhstan at the top of that list, and US being third. Is that because some of the deals might be lumpy, or does this mean there's a shift more towards energy sort of deals?
Yeah, I think the US, there's obviously a big movement with all the shale gas that's coming out there. I think that there's a lot of money invested there, although people have burned their fingers already because the prices keep on dropping.
Supply and demand, as you say.
Exactly. So, Russia, as the technologies come out, I think there is a lot of, there is a lot of opportunity in the oil sector, but at the same time they're under pressure because people are scared that the shale gas is going to knock a lot of people. Sasol, interestingly, is quite well placed for that, obviously with their feedstock being the gas. So that's an interesting opportunity from one of the local players.
So Stephan, what are you telling your clients? When do you see a turning point, or what could be the trigger for this turning point? Does it all come down to the policymakers and Bernanke and European Central Bank and so on?
Yeah, I think you have to look at the statistics coming out. You have to be on top of where the price of your commodity is going. You must look at demand and supply, and there's a lot of information coming out from different banks And you have to tap into that and start get a feel for the market.
He's not committing, Nick. What do you say?
Look, it's all about valuation. So trying to pick a turning point is very tough. But let's take Anglo American as a great local proxy. That was trading at around 4 or 5 times book value a few years ago. It's trading below book value now. So I don't know when these things are going to turn, but that's quite a significant discount and probably a much more rational pricing level. So yeah, I think it's about looking at valuations and again looking at the fundamentals of the industry. So we've chatted at length about platinum. The fundamentals for platinum are good. The fundamental for oil is relatively good because of the supply and demand. Iron ore's got problems on the supply side and the demand side. We've seen mammoth amounts, so that capex I talked about was largely into new iron ore mines, which have been dug up around the world. So there's a mammoth amount of supply. At the same time, the biggest consumer, China, is probably starting to taper off. So even if it doesn't crash, as that economy evolves, they're going to be using less steel and more sort of other advanced goods, and that's a big concern to have both of those moving in the wrong direction.
Yeah.
So Nick, sorry, Stephan, yes?
Yeah, it's not, you can look at all the statistics, but sometimes you have to sort of read between the lines as well. I think the South African market, for example, on coal is quite interesting. If you go and speak to Australian investors on coal, I don't think they read the South African market with the exception of 1 or 2. I mean, we've just done the inward listing for WCC, Waterberg Coal Company. So obviously there's an Eskom problem that's got to be solved. And if you're a BE company going into coal supply to Eskom, where 4 or 5 years ago you would have said, that sort of marginal business, that can actually become very profitable. So, the market hasn't picked up on that in Australia. You still go to some investors from that angle that say, well, South Africa's a no-go. I was sat in a private equity firm about 3 months ago, and the door was just closed. It's not all the investors, those are probably the exceptions, but they're still trying to understand our climate and labour and everything that goes with it.
Yeah, and that negative sentiment, that's often where the opportunities come. So, on the surface, do we want to touch Anglos, focus on South Africa, labour issues, etc., or Billiton, great global business? Well, clearly Billiton's a better business, but Billiton's trading at 3 times book and Anglos is at 1. So, somewhere in between is the opportunity, I think.
So it's a matter of patience, reading the signs correctly, and where others are pessimistic and worried, to take action and grab the opportunities. Do you
Absolutely.
Yeah. Gentlemen, thank you. Good having you here and good hearing your views. Thanks to my guests, Stephan Le Roux from Bravura and Nick Norman-Smith from Lentus Asset Management. And that's a wrap of this edition of Deal Flow. Do tune in again next week to get the latest news and views on mergers and acquisitions in Africa and beyond. Until then, from me, Erica van der Merwitz, good night.